Volatility explodes, stock markets crash, crypto has the worst flash crash in history, and the dollar screams a red alert. With just one tweet, the US stock market vaporized a staggering $1.8 trillion of wealth, sending huge shockwaves to equities, currency, crypto, and commodities. But what does it all mean? So, of course, yesterday, the S&P 500 had a massive move, evaporated $1.8 trillion in market cap. This is more than the annual economic output of entire countries like the Netherlands, Saudi Arabia, and Poland. So absolutely massive moves. The NASDAQ and tech stocks finished the day down about 3.5%. Now, of course, the losses were amplified in certain areas. NVIDIA down about 5%, Amazon down about 5%, and Tesla down about 5%. So why did this all happen? Well, President Trump yesterday morning put out this rambling tweet basically saying that he is hearing China is going around the world trying to impose export restrictions on various rare earth minerals and starts to threaten China with an escalation of trade tensions, saying we have all the leverage here in the U.S. Now, whether or not that is true, I guess only time will tell. There are certainly indications China has more leverage. Here we're looking at USAR and MP Materials. These are two domestic rare earth mining companies up sharply over the past 2 days. We can see USAR up 22% over the past 2 days alone. So Trump would go on to then say, we are raising the tariff on China by 100%, which basically amounts to a trade embargo. Here we're looking at the front month S&P 500 futures contract down 3.3% on the day. Now, this has happened 19 other times in the past decade, so it's not unheard of, but it's certainly out of the ordinary. 2.6 standard deviation move once you factor in volatility. Well, looking at volatility, I had warned about a week ago for the members of a volatility event for a number of reasons. So number one was you were starting to get a 50 moving average cross on the daily. This indicates a change in trend. And you also had volatility in the S&P 500 moving up together in unison. You normally don't get that, as you can see. Normally is a very negative correlation, but I was noticing that basically every day they were moving up in unison. So I decided to run this correlation coefficient, found very, very high positive correlation. Has not been that high going all the way back to Volmageddon in 2018, which of course was a huge volatility event, and August of 2020. I also noticed that LQD over HYG, a proxy for credit spreads, was starting to perk up over the past month or so, and you're starting to get some expansion in credit spreads. Now, B of A high yield credit spread index, here we can see has been moving sharply higher, going all the way back to late September. So credit spreads have been moving higher, but they are moving higher from a very, very tight base. So if we look on a long time frame, we can see that credit spreads where they are now, you really have to go back to 2007 for credit spreads to be this tight. June, July of 2007. Of course, we know what ended up happening later. If you are looking for a higher frequency way to watch credit spreads, I would highly recommend LQD over HYG. Those are two ETFs that track various different, this is investment grade bonds and then, of course, high yield bonds. And what this is indicating is the market's perception of credit risk. So, of course, volatility expanded yesterday. We did get that volatility event. Bitcoin volatility up sharply. Of course, we'll get to crypto in a second. Move or bond market volatility also up, but not up nearly as much as we see with the VIX, with gold, with Bitcoin. Here we can see that gold volatility up quite sharply. Of course, gold ended up showing strength. This is one of the things we'll talk about with the dollar in a second here. Equity volatility, the VIX, 21 handle. So not unheard of levels for the VIX. You do get spikes in the VIX like this. 21 is certainly notable, but it's not end of the world sort of territory in any sense. So I want to also say that I've been noticing this kind of on Twitter and various social media. I've been noting this kind of short volatility strategy, and so many people, it's just so easy. All you got to do is sell puts, sell calls, monetize volatility, go with these short volatility ETFs, these quote unquote income ETFs. Well, we've seen this story before. And of course, when everyone is short volatility, it generally does not end up well for them. So here's the S&P 500 in green, and then implied correlation. So this is another way of thinking about implied volatility. And here we can see the difference between the implied volatility of an index like the S&P 500 relative to the volatility of individual stocks within that index. And what we can see is when we get a correlation to one sort of event, like we were starting to get yesterday, where everything gets sold in unison, implied volatility on everything starts to move together. Generally, that corresponds to an equity market bottom. Now, one note of caution: we're looking in hindsight here. We're looking in the past, and of course, it's very easy to spot there. During early April, I was watching implied correlations. They were spiking quite notably, but then the next day they would move higher, and then the next day they'd move even higher. So implied correlations can always go more positive. So I would just urge that note of caution. But generally speaking, when you get a spike in volatility, when you get a spike in implied correlations, generally you're pretty close to a bottom. So what is the signal through all of this explosion of volatility and all of this market mayhem yesterday? Well, here it is. One of them. We'll get to the dollar in a second. So here's crude oil, copper, and the 10-year treasury yield. Remember, that is inverse to the bond price. And what we can see is they were moving in unison. This is just starting yesterday at midnight. We can see that crude oil, copper, and the 10-year treasury yield all move lower basically in unison. Well, copper and oil are one way to think about the market's expectation for kind of global growth. And so really what this escalation in the trade war is signifying to the market is a negative growth shock. And of course, we saw this in early April. Bonds actually sold off in face of that negative growth shock, which was quite concerning. It was the early stage of a balance of payments crisis, arguably. We did not see that. We'll get to the bond market in a second. But you had oil, 10-year treasury yield pricing in lower aggregate growth, kind of globally speaking. Now, we know GDP is running at about 3.9%, so maybe they have some room to work with. Here, we're looking at crypto, which in the latter half of the day, certainly after market close, you had President Trump put out a tweet that just sent the crypto market just absolutely tanking. So at one point, excluding the top 10 cryptos like Bitcoin, Ethereum, and those, excluding the top 10 biggest ones, the rest of crypto at one point was down 45% in a matter of like 15 minutes. It was wild. So here's a meme that I just thought was funny. It's not funny when people lose a bunch of money, but this is just another warning. Leverage carries risk. And of course, you have these volatility events when no one is expecting it. The entire market seemed to be short volatility, as I noted in the prior slide. Of course, we had the largest single day liquidation event ever, bigger than Luna, bigger than COVID, bigger than FTX. And of course, we're going to go through a couple other screenshots that I thought were notable here. 1,000 traders lost over $100,000. 200 traders lost more than $1 million yesterday. 358 of those accounts lost everything. So people just getting absolutely wrecked in crypto land. Here we can see at one point, this was near the worst of it. You had some cryptos that were down like 56%. Just absolutely wild. And it happened very, very quickly. Here we can see Bitcoin liquidations, $5.3 billion, Ethereum, $4.4 billion over the 24-hour period. And of course, there were suspicious trades. It wouldn't be modern day 2025 without some suspicious trades. So here's a $28 million leverage trade on ETH that was opened right before President Trump put out some of those tweets. Crypto, of course, it should be noted, has ended up recovering quite nicely. So is not down nearly as much. It still is down from where it was at the start of the day yesterday, but it has recovered a good amount. This was one of those flash crash sort of events where there's kind of no bid. So it has recovered. DXY dollar index, this is the other signal in yesterday's chaos. DXY dollar, the dollar did not get bid yesterday in the face of a negative growth shock, in the face of a risk off, clearly a risk off event, risk off day in the market. Normally you would see the dollar get bid. Well, just like I was noting in February and March earlier this year, before April ever happened, I was noting that, in Europe and Asia session, you would see equities down, S&P futures would be down, bond yields would be up, and the dollar would be down. And so I started to look around to, okay, well, if the dollar's down, it's got to be going somewhere. Where was it going? It was going the euro, the yen, and the Swiss franc. So it was apparent even before the Liberation Day chaos, which of course just amplified things. Well, we're starting to get signals of that yet again. The dollar sold off versus all three of those currencies yesterday. Generally, you don't see that in a risk off sort of event or a negative growth sort of shock as we saw yesterday. Not just that, but gold initially pumped on the news, as we can see there, then sold off, but ended up closing the day higher. Here we're starting the day at midnight yesterday. So gold finished the day up 1.3%. So even in a kind of correlation to one sort of event, gold initially did get sold to some degree, but it ended up recovering and showing strength. So again, if it's not the dollar, what is it? Well, it's the euro, the yen, the Swiss franc, and of course, gold. So it was not Bitcoin. That risk, Bitcoin being a risk-off asset did not prove itself yesterday at all, as we'll see in a second. So yields across the curve were down quite notably, and they were also down all over the world. So Canada, Australia, Great Britain, Germany, France, Italy, all of these yields were down. Now, again, the Japanese 10-year yield was up. So that's kind of the second day in a row where yields are coming down, bonds are getting bid all over the world except in Japan. So I think that there's some signal there. Yields down across the curve here in the US. Again, lower growth expectations. The yield curve didn't really do much. It didn't really flatten, didn't really steepen. So to finish up here, here we can see, of course, kind of cross asset. Basically, huge volatility event, S&P 500. No one was really expecting this, as was indicated by the volatility index just absolutely ripping. Bitcoin selling off quite sharply along with crypto, seeing the largest liquidation event in crypto history, and bonds all over the world, not just the US, bonds actually serving as that safe haven to some degree, but you had the dollar selling off. Well, if the dollar was selling off in a risk off sort of event, in a negative growth shock sort of event, what was getting bid? Again, just like February and March of earlier this year in April, it was the euro, the yen, the Swiss franc, and of course, gold with a very, very bullish looking daily candle. So again, this kind of broader regime shift out of dollar denominated assets. Of course, bonds did get bid, but the dollar sold off into gold, into the Swiss franc, into the yen, into the euro. That is signaling something very, very notable, a regime shift all over the world. So if you have not seen the global monetary reordering video that I did a couple days ago, I will link that here at the end of this video. I would highly recommend it. I think we are witnessing history. So again, anyways, hopefully that was helpful. I would point out the membership is there for those that would like more market-based sort of stuff. That is where all of that goes. And I did warn members, people were able to get out of risk, and we're very thankful for that. So just trying to provide value. If you like that, if you want that, it's there. If you don't, we'll continue to be doing these sort of videos. So anyways, hopefully that was helpful, and I'll catch you in the next one.